Passive income is the idea that you can make money without doing any work, and that whole concept is kind of true, but it's also kind of a lie. There's no true way to create an income that will pay you forever without you having to do anything. There are three general ways that I generate cash flow, and some of these are way more passive than others. They are PRR, purr, kind of like a kitty cat. Profits, rents, and royalties. Let me start by talking about the P, the profits, because there's two ways that I generate cash flow from profits. One is through my own businesses, this is much more active, and one is through public companies. This is much more passive. My own companies, I own a couple companies. I own Market Insiders and I own Briefs Media. These are two companies that have their own staff, so we have our own products, and each has their own monetization strategy. And each one of these, when they have a profit at the end of the year, because I own the companies, I control the profit. Now I get to choose how much of this money I want to reinvest back into the company and how much money I want to take out for myself. Now, in order for me to generate this type of profit, I have to work in the companies, because right now I am the CEO of both companies. So I come up with ideas of how do we grow the company, how do we manage the team, how do we increase revenues, how do we increase profits, and where do we invest our money. All these things are things that I'm working on, things that I'm operating, and things that I'm constantly spending time on. So these are active investments for me because I have put my own money into these companies, I have put my own time into these companies, and these are companies that I'm actively working to grow. On the public and much more passive side, I invest some of my money into the stock market, and I invest my money in the stock market in two ways. I have an active investment and a passive investment strategy. My active investment strategy is where I look for companies that I like, that I believe are undervalued, and when I find a good company, I'm going to come in and buy. On the passive side, I have a system where every Wednesday, I have cash that automatically leaves my checking account and is invested into my portfolio of different ETFs. That's completely passive. And in this ETF portfolio, the largest chunk of that is a dividend pie, a dividend slice of ETFs where I have multiple different dividend paying ETFs, high dividend paying ETFs that I invest my money into. So every Wednesday, I have cash that leaves my checking account that is invested into a portfolio of different ETFs, but the ETFs that get the most cash every Wednesday are my high dividend paying ETFs because cash flow is king. Let me break down what this means from the simplest aspect, which is you have some companies that trade on the stock market. When a company trades on the stock market, they become a publicly traded company, and anybody, you, me, anybody else can buy shares of these companies. And when you buy a share of this company, you can make money one of two ways. You can make money when the stock price goes up because now this company is more valuable, or second, you can make money when this company has a whole bunch of cash in their bank account and they give it away to the shareholders, people like you and me, in the form of dividends. Dividends are regular cash payouts that companies pay out to their shareholders, typically every quarter, meaning every 3 months, and this is cash that you get without having to sell your stock, and you don't have to do anything. You just get this cash deposited into your investment brokerage account. So if you invest in a company that's paying a dividend, because not all companies pay a dividend, well, if you own that company, well, now you're going to get a check or you're going to get cash deposited into your bank account for doing nothing except owning the stock. The reason why I don't say it's completely passive, although it is very passive, is because you still have to research the company. You still have to make sure that this company is not on the verge of bankruptcy. You still have to make sure that this is a good investment, because you don't just want to buy a company or a stock or an ETF because it pays out a dividend. You want to make sure that the underlying investment, the underlying asset, the company, is a good company. So it requires some research and work on your part, because you don't want to invest your money into this thing that pays you dividends for 2 years and then your investment goes to zero. So you want to make sure that not only are you getting your cash flow, but you own a good investment that's hopefully going up in value. That's where the research and time comes into play. Now, instead of investing into individual companies, you can also invest into ETFs. ETFs are funds that give you exposure to a lot of companies. And there are some ETFs out there that have the sole purpose of investing into high dividend paying companies. That way now you kind of diversify your investments into high dividend paying companies, because you invest into one fund, one ETF, and this gives you exposure to dozens or hundreds of different high dividend paying companies. That's what I do. Now, I do have some companies that I invest in individually that also pay me dividends, but what's much more passive is when I invest into these ETFs, because now every Wednesday I'm buying more of these dividend paying ETFs because I want to build that cash flow, because cash flow is king. I like that type of cash flow because I want to be able to live my life not based off of how much work I'm doing, not based off of what my salary is for my jobs, but based off of the cash flow that I can get that's coming in pretty passively, because I can manage these with much less effort, with much less time than me actually running my companies. So I like cash flow. That's how I invest my money, and you're gonna see that throughout this video. But when it comes to dividends, this is when you invest in companies that are paying out a cash flow dividend. Now, there are other investments that you can make, like I invest my money into non-cash flow producing companies as well, but that's a smaller piece of my stock market portfolio. I also invest in startups, but these startup investments that I make don't pay out any cash flow. And so when a company's paying out cash flow, when a company's paying out dividends, they have a completely different game plan and a completely different investment. And you got to understand what makes sense in your portfolio for your position. Because if a company has enough cash to pay out a dividend, what that means is they're taking this cash and instead of investing it back into the company to grow the company bigger, to make it into a larger company, to grow faster, they're taking this cash, pulling it out of the company, and they're giving it to the shareholders, the investors. So this company is pretty large, and you're not going to see this company grow as fast as they could if they invested this money back into the company. So you have to kind of pick that balance. What do you want? Do you want a company that's growing faster in price, or do you want a company that's paying you cash flow? For me, I like cash flow. I do have some companies that I invest in for more of the growth side, but a larger piece of my portfolio is for cash flow because cash flow is king. You're going to be saying that with me by the end of this video. So I like cash flow, which is why the biggest chunk of my investments are cash flow producing investments. Now in the stock market, I do have a piece of my investments that are going into more speculative, more innovative side of things. This is more risky, where it's more on the side of growth, but that's a smaller piece of my portfolio. Just like when I invest in startups, startups many times don't have a profit. They don't have any cash to pay out dividends. What they're doing is they're trying to grow as quick as possible, as fast as possible. I invest in startups, but when I invest in a startup, I'm not looking for cash flow. I'm looking for growth. Again, I invest in startups, but I have more of a dividend cash flow producing portfolio than I do a startup portfolio. So understanding where it is that you want to invest and understanding what type of portfolio you want and what type of growth you want. I like investing in startups. I like investing in innovation. For me, that's fun, but that's more of a speculative part of my portfolio than it is the bulk value side of my portfolio. The reason why so many people get discouraged when they look at investing their money for this type of cash flow is because they run the numbers and then they get very discouraged. They say, if I can find an investment that's paying me, say, a 4% annual dividend yield, it's going to cost me $150,000 today to get this 4% return, which is going to pay me $500 a month or $6,000 a year. I don't have $150,000, so it's not even worth it for me to start. But what you're missing is you don't have to invest all $150,000 today. If you create a passive investing system, you could invest $100 a week, $50 a week, $10 a week. And what you're doing now is you're starting the cash flow system. And you have to start somewhere. You got to start with $10, $1, $200, $2,000. It doesn't matter. Everybody has to start somewhere. And now you start. And you keep investing every time you get paid. Ideally, every week. You want to be investing as often as possible. And no matter what, you always want to have some cash to put aside. And if you do this, not for 6 months, but if you do this for years, every 12 months, you're going to look back and you're going to see the progress that you made. And now, every year, you're going to be getting bigger cash flow statements because now what you're doing is you're putting more money in. Every time you buy more of this investment, you're going to get more cash flow out. It's buying a machine that pays you with cash. The more you buy, the more cash flow you get. So each year, you're getting more cash flow. And on top of that, if you want to get even more aggressive, you can automatically reinvest the cash flow that you're getting. You can reinvest the dividends. So not only are you working to invest more money, but now every time you get paid, you can buy more of this machine that's paying you with cash flow. It's like a whole cycle where you just keep buying more of the cash flow and using your cash flow to buy more cash flow until you're ready to ultimately use the cash flow because cash flow is king. So this is where you want to understand that you don't need to put in all $150,000 right now to make it worthwhile. Start with $100, start with $1,000, start with $10,000, start wherever you are. Just consistently keep investing your money. That way you can build up your cash flow portfolio. But if you have access to more cash, the second place where you can generate this type of cash flow, if you want to do it outside of your own business, is to do it through rents. The way rental cash flow works is you're going to go out and invest in some real estate. You're going to own a property, a house, an apartment complex, an office. You're going to own some sort of building, and then this building you're going to rent out to somebody else. Somebody's going to live there, or a business who's going to use your property. And in exchange for this person or business or thing using your property, they're going to pay you rent. And if you do it correctly, this rent is going to cover all of your expenses and put some money in your pocket every single month. And if you know how to do it the right way, well, it can be completely passive on your end after you buy the property and after you build the right team. I have other videos on my channel where I go over how to actually invest your money in real estate. So if you want to learn more about that, you can check out those videos. But the key here now in terms of rent is how active do you have to be? It's not as passive as investing your money into dividend-paying stocks, and it's not as active as building your own business. So where in the middle is it? Well, if you're just starting off, it's going to be more on the active side because you're going to have to go through all the hurdles and hoops to learn how to invest in real estate. But once you build the right team, once you have the experience, well, then it's going to fall much more on the passive side. When I invest in real estate, it's much more passive for me because once I find the property, I know exactly who I have to call, who I have to text, and then I pass on the duties onto them, and everybody knows what to do. And then I just walk away and I let my team do its thing, and I let my property manager handle the entire process. Now, when it comes to cash flow, there's two things that you have to understand. First thing I want to say is there is a lot of different ways now for you to get exposure to real estate investments without actually investing your money in real estate. The old way to do this was to invest your money into a real estate syndicate deal. The way that worked was if you go to any real estate investor meeting, they happen around the country, there's always people there, always, who are looking for cash. They're looking for investors that way can raise money, that way they can go on and buy a property. The way it would work is like this. Let's assume that this is an apartment complex and it costs, I don't know, $5 million. If it costs $5 million, this investor is going to need $1 million of cash to raise the debt to buy this property. So they're going to borrow $4 million and get $1 million worth of cash. If they don't have $1 million worth of cash themselves, they're going to have to raise this cash from other people. Maybe they have $100,000 themselves and they have to raise the other $900,000 from investors. Well, if you go to these real estate meetings, there's always people who are trying to raise this $900,000. And you could be one of the people who invest maybe $10,000, $100,000 or more that you invest into this, where now you own a piece of equity, and then they're going to work to buy the property, renovate it, and get it rented out, and then pay you maybe with cash flow, or they pay you when they sell the property or refinance. They might have a deal that says you invest $100,000 and then I'm going to pay you a 15% return over the next 3 years. It just depends on the deal, depends on the investor. Everybody is different. But this was the original passive way for somebody to invest in real estate without actually investing in real estate. It's a way for you to get exposure to a deal without actually being a part of the deal, because now you're passive. You're letting the investor, the developer, do all the work. You're just giving them the cash. Now, thanks to technology, there's a lot of different crowdfunding sites that allow you to do something similar without actually getting exposure to the deal. So if that's something that you're interested in, you can look at some of the crowdfunding sites out there to see if there's something that you like. Now, when it comes to you actually owning the property, now you are the developer, you own the building, you own the property, and now the cash flow is going into your pocket. The reason why wealthy people love investing in real estate, this was something that I had to learn through reading books because nobody ever told me this before. I wish we would have learned this stuff in school, but the reason why wealthy people love owning real estate is because wealthy people have a lot of money. Now, when you have a lot of money, where are you going to keep it? You can keep it in the bank, but the bank is only FDIC insured up to $250,000. Now, you don't need $250,000 or more to do this. You can do this with a lot less, but I'm telling you what wealthy people think. They have more than $250,000, so they don't want to keep it in the bank because now this money is at risk of potentially losing if something happened to the bank. Second, your bank isn't paying that much interest. And third, your bank is losing value to inflation. So now what wealthy people do is they take this cash and they want to move it somewhere safe. Well, what's a safe place to leave it? Well, you can put it in the stock market, but we all know the stock market is very volatile. You can see the price of the stock market get cut in half in a day. I mean, we've seen crazy things happen in the stock market. And so wealthy people want to own something tangible, something that holds its value a little bit better. Now, does this mean that real estate never goes down in value? No. We saw the 2008 crash happen where real estate prices were slashed into a fraction of what they were before. However, you don't see the same volatility in real estate the same way you do in the stock market because you can't buy and sell a property the way you can buy and sell a stock. So real estate holds its value better, but that doesn't mean it only goes up in price. Real estate does go up and down. However, you don't see the same fluctuations. So number one, it allows you to own a tangible piece of property. Second, some people use real estate as a way to buy more because they can use debt to buy more real estate. And third, you get tax breaks from your real estate because now real estate offers some of the biggest and best tax breaks that our tax code has to offer. And then fourth, on top of that, while you own the property, you're also getting paid with cash flow. And if you do it right, this cash flow is going to be way more than the interest you would get from the bank. This is why wealthy people love investing in real estate. Now, the nice thing is you don't need a ton of cash. You don't need millions of dollars to start investing in real estate. You do need some cash. If you don't have $50,000 saved up, it's going to be very hard for you to start investing in real estate unless you are involved in these type of syndication deals, or unless you are a developer, you're a hustler, you're a salesperson, and you can go out and get the cash to invest in these properties. If you just want to invest in real estate and you don't have access to $50,000 worth of cash, it's going to be very hard for you to actually go out and buy a property. Real estate is my largest investment outside of my own businesses. The reason why I like real estate is because of the cash flow, because when I go out and I buy a property, I know that I can create cash flow from this property. If I spend $100,000 on a property, my goal is 7% cash on cash return. Meaning for every dollar that I invest, 7 cents come back into my pocket every single year as profit. If I invest $100,000, that's $7,000 a year in positive cash flow. So my goal, especially when I started investing in real estate, was anytime I made money, was I took this cash and I bought a property. I made cash and I bought a property. I made some money, I bought a property. That was it. I wasn't spending any money on myself. The only thing that I was buying was real estate because I knew that the real estate would pay me with cash flow and I could spend that cash flow and not have to worry too much because I knew the cash flow was going to come back next month. That's the value with real estate. It takes a lot of sacrifice because that means you're going to have to make big sacrifices with your money. You're going to have to take big chunks of cash and take it to go out and buy a property. However, if you can stay consistent with that over the course of years, over the course of a decade, you can build a lot of cash flow. And what a lot of people like to do in the real estate investor community is they make a goal of just buying one property a year, one home a year. If you can buy one property a year, you can save up to do that. Well, each year you're going to be adding on more and more cash flow. And every year it's going to become a little bit easier for you to buy another property because you can save up the cash flow that you're making for one property and use it to buy a second one. Use the 2 to help you buy a third one. Use the 3 to help you buy a fourth one. So it's all about stacking cash flow. You want to make money, use it to buy real estate, and then use the real estate cash flow to help you buy another property. It's like the game of Monopoly. You just keep working over time to buy more of that cash flow. Now, if you're struggling to be able to buy that first property, then maybe you have an income problem. Maybe you have a spending problem. And the income problem can be fixed by making more money. How do you make more money? Well, that's a topic for a different video, but you look at creating a side hustle, look at creating a side business, look at creating your own business, look for ways to create your own income. You don't have to be a salesperson to do this. I'm not a very good salesperson, but there are many ways for you to produce more value. If you like the idea of being an entrepreneur, of how you can create more income. There are so many different ways out there, and the internet has made it so much more accessible, not easier, but more accessible so anybody can start creating more income. And then it's, what do you do with that income? Do you buy a bigger car? Do you go on another vacation? Do you go to nicer restaurants? Or do you go out and buy real estate? For 10 years of my life, I spent no money at all on myself. I drove a beat down car. I didn't eat at restaurants. I didn't go on vacations. I wasn't going out with my friends. I wasn't spending money so I could do one thing: buy real estate and create rentable income. That was what I worked on for a long time, and I made a lot of sacrifices for that. Now I spend a lot more money, but I have the ability to do that because not only do I make more money from my businesses, but I also have my cash flow from my real estate. I have cash flow from my dividends, and I still have a system where every year I'm working to create more cash flow through real estate properties, through my dividends, because cash flow is king. The third way that you can generate cash flow is through royalties. And again, this can be somewhere between active and passive depending on how you build it. And there's 2 ways to generate these types of royalties. One is through physical products, one is through digital products. Before I was on YouTube, I was in the sock industry. I used to have a sock company where I created this water resistant athletic sock, and I would sell this online. Now, unlike most people who sell products online, my goal wasn't to build a sock company. My goal was to license the technology that I had. So I worked with sock manufacturers, I worked with textile engineers, and I worked with a whole bunch of other different types of engineers when it comes to apparel engineers to create this water-resistant technology to build a sock that was water-resistant. And that's what I did. The technology already existed, but it was never used in socks until I came around. And so I used this technology to make these water-resistant socks, and we had a great company. But my goal by selling it online wasn't to build a sock company. It was to have a proof of concept that way I could then take this technology and license it to the other major sock manufacturers and other retail companies out there. The problem was I didn't create this technology. I created a new use for this technology because I was the first to find a way to put it into socks, but it wasn't enough for me to get approved for a patent. So all the licensing deals that I had pending all fell through when I didn't get the patent because none of these companies had to pay me a royalty fee to use my technology because they could just bypass me and do it themselves. So it didn't work, which is why I shut that company down, along with me seeing success in other places. However, if it did work, that would be an example of a physical royalty. Many times people think of you building a business as a royalty, but that's not really royalties because you have to build the business and then what you get is profits. I talked about that earlier in this video where profits are different than royalties. It's different ways to generate cash flow, but royalties are now where you create something and then you get paid for the thing that you created for years into the future because of that one thing that you created. So one way to do this is through royalties. Another example of a physical version of these types of royalties will be writing a book. Authors who write a book, if you can get it into stores, if you can get it onto Amazon, if you can get it into places where people keep selling and buying your book, well, now you create royalties where now every month or every quarter, every year, you're going to get a check from your publisher because of all the sales that your book is bringing in. Now, I don't have experience with this. I have never written a book before. I don't have a book, but I know people who are authors who make a decent amount of money through royalties from their books. I hear it's not a ton of money, but a decent amount of money unless you can sell a ton of books. But if you can build a book and people are buying it, and publishers are pushing it, well, now you can start getting royalties from the books that you're selling. On the digital side, most of this has to do with content. This is ebooks that you create and you sell online as opposed to a physical book. This could be YouTube videos that are still generating ad dollars years after you produce the video. This could be blog posts that are generating traffic, that are making you affiliate money or sponsorship money. And this could be podcasts that people listen to years after you publish it that are still generating you advertising dollars. Now, as somebody who is on YouTube, I can tell you from experience that yeah, you can make good money through advertising dollars. However, the way that it works in the content game is there are a lot of people that are trying to create more content. So unless you keep creating more content and unless you keep creating good content, your old content stops getting views and your old content stops driving revenue. So the whole idea people think is if you make a video now and this video goes viral, you're going to get paid for that video for years into the future. But the reality is if you want to keep getting paid for that video that you made years ago, you have to keep producing good videos today. So it's kind of a pseudo passive income in the sense that, yeah, you can still generate revenue from old content, but in order for the old content to keep generating you new revenue, you have to keep producing good new content. Now, of course, if you are a business owner and you're looking for more resources on how to stay up to date on business trends and business innovation and what's happening in the business world, you can check out Business Briefs. It's a completely free resource that I created to help entrepreneurs stay up to date on business trends, to understand what's happening with innovation, to understand what's happening in terms of funding. That way you can make better decisions in your business. Business Briefs is completely free. And if you haven't joined Business Briefs yet, I'll put the link to how you can join Business Briefs for free down in the description below. But when it comes to this type of cash flow, the general consensus is there's two different ways to create cash flow. One is you can buy it. The second is if you can build it. If you have money, but you don't have time, then you could go out and buy the cash flow. We talked about some of the passive ways. You can do it through dividend investing in the stock market. You could pick your own strategy there. You could do it through real estate. Creating royalties is going to be a lot harder for you to do much more passively. But if you have cash, you can go out and create this type of cash flow by buying the cash flow. If you have time, but no money, and the next thing is you can build the cash flow. You can build your own business. You can build something that pays you with royalties. That is now something you build with your time, and if you do it the right way, it can pay you with cash flow. Now, are you going to succeed? No, everything has risks, but what you're trying to do is you're trying to build something that pays you with cash flow, because cash flow is king. And if you want to be able to live your life financially free, you need to have cash flow coming in that allows you to live your life. And the issue that a lot of people have is they work to build more of a sporadic cash flow, and then they start living this very nice lifestyle. You see a lot of salespeople do this. I am a licensed real estate salesperson. I've worked with a lot of salespeople, and this is one of the biggest problems with salespeople. You go through these big months or these big years, the economy is booming and you make a ton of money, and now you start driving a nice car, you start wearing expensive clothes, you start going to nice restaurants and go to these expensive vacations, and then a couple years later, the economy takes a turn. Now that cash flow starts to go away. And now you don't have the same ability to live the same lifestyle, and many people don't want to give up that lifestyle, so you now start going into debt to keep funding the lifestyle, and then you run into a whole bunch of other issues. This happens all the time, especially with salespeople, because that cash flow isn't consistent. The goal with the things that I talked about is to create a consistent cash flow, that even if things go wrong, you will still get some cash flow. Maybe you have to cut your rents, maybe some of your dividends go down, but you still have cash flow coming in. That way you can continue living your life, because if you can live your life based off of the cash flows that I just talked about and showed you, now you can live a much more sustainable life and a much more financially free life, because you can keep doing your thing while the cash flow keeps coming in. So this is where you have to be smart financially and understand how to use your money the right way. That way you can generate enough cash flow to live your life the way you want. And if you do it correctly, then you can spend all your money and get more cash flow next month. Passive income is the holy grail when it comes to wealth building, because now you are earning money while you sleep. This is what wealthy people spend all their time building. They want passive income. We all only have 24 hours in a day, and you don't want to spend 20 of those 24 hours working. You want to have your money working for you, and this is what passive income is all about.